Back John Goldsmith, who's been joining us this morning from Montrusco Bolton to talk about the mood of the markets, to see some deal activity in the steel sector. What's your take on that?
Look, I think part of it might have to do with the likelihood that with a Trump presidency, there's going to be more reshoring there. So that could definitely help the U.S. steel makers. I'm not terribly surprised. I think the deal in and of itself is great. Stelco has, for the last couple of years, traded a massive discount to U.S. players. So you mentioned Cleveland, U.S. Steel, Nucor, Steel Dynamics. They're trading literally twice the multiple. So this multiple that ends up getting paid is roughly 4.8 times the last 12 months trailing EBITDA, which is kind of in line with what Cleveland is trading at right now. So I think they played a very nice price for it, and you'll see with the premium that just goes through.
Well, let's stay on the theme of valuations, because I wanted to ask you about your view on the Canadian stock market. Yes, we've seen U.S. record highs, but now the Canadian stock market is at an all-time high. And when you look at some of the strategists that are pulled by Bloomberg on what could happen for the TSX over the next 12 months, some would not be surprised to see better performance for the Canadian market versus the U.S. market. Part of that is based on the valuations of Canadian equities. How do you feel about the Canadian stock market right now?
So I feel very positive on the Canadian stock market, primarily because of, over the next couple of years, with regards to the whole energy transition theme, Canada, there's not a lot of places in the world where you can play public equity markets and commodities that are liquid, and companies that have basically found a newfound religion, if you will, with regards to reallocating cash back to shareholders in the form of dividend share buybacks and debt repurchases. So, that is a really good backdrop. But with regards to the valuation point in and of itself, Canada always trades at a discount to the U.S. I mean, pretty much every country in the world trades at a discount to the U.S. And the discount that Canada trades at today is not really that significantly greater than what it has been over the last 10 years. It's not like some 2 or 3 sigma or standard deviation event. So I think really it'll come down to, once again, Canadian companies being able to throw off better earnings and cash flow. And once again, we talked about the concentration in the U.S. If the Mag 6 or 7 end up hitting a little bit of an air pocket and then relying on the remaining 494 companies in the U.S. to kind of pull the weight, I think that's the interesting trade for Canada as opposed to the U.S.
The other big theme in Canada, obviously, is what's happening on our housing market. This week, we'll be watching what is happening on the inflation front. We'll get some data tomorrow. We'll see how that impacts the thinking around interest rates. But as an investor, you have been watching some of the equities associated with the housing play. Main Street Equity is one example, for example, of a company that you like right now. How come?
So, the big issue in Canada is, if you take a look at where's some of the biggest issues with regards to housing affordability worldwide, Canada is, probably, ground zero for it. Whether it's being exacerbated because of the rates, the lack of building, the increase in immigration. But the beauty of Main Street Equity, it's about $1.5 billion market cap. It's a multi-res. It's about 19,000 units, primarily in the Alberta, Saskatchewan, Manitoba geographies, with also a decent chunk in BC. These are areas, especially as it pertains to Alberta and Saskatchewan, that are not rent controlled. The other thing that makes Main Street Equity really interesting is the fact that, as opposed to a lot of the other multi-res units, they don't pay a dividend, which means that they're not forced to pay out 70, 80, 90% of their cash flow in the form of dividends and then having to, reshore the balance sheet to go do deals. All that cash flow basically comes to them, and they can do that then to do deals, and they can source deals better than anybody else in the geographies that they're in, because they're extremely well plugged in.
And then just on the interest rate front, because I think everybody in the housing market's watching that very closely, and we do have that inflation data tomorrow. What do you think plays out in Canada for the rest of the year? What's your thinking?
There's probably another 2 cuts. So I think July, so the next couple of next week or so, you're going to get another cut in Canada, and then you're most likely going to have another one. I'm actually very positively surprised by how strong the Canadian dollar is held up versus the greenback. You would have thought that the Canada moves, way before the U.S., you'd start to see a big weakening. And I think a lot of that has to do with how people or traders are positioning. Canada maybe, or Europe and Japan, they're maybe taking the lead right now, but eventually, growth in the U.S. will slow down a little bit. And at that point in time, that relative trade makes the Canadian currencies or non-U.S. currencies a bit more attractive. But getting back to the housing question, I think once again, What the government wants to avoid is the reset of rates in 2025, because that's going to be 5 years post like the trough in rates. And that could have a major negative impact in terms of economic growth. So if you can get a little bit of support from that side for the housing, because Canada is extremely levered to housing, I think that would be a very good backdrop. I think it's probably already priced in the market for 3 cuts this year. I think the question is next year, how aggressively the Bank of Canada is going to have to cut. And is it 3 or 4 rates, 3 or 4 cuts? I think that's the big question there. But 3 or 4, you're looking close to another 100 basis points next year off of 75 bips this year. It's close to 2% off. I think that will probably do a pretty good job of dampening the negative effect of the rise in rates over the last 5 years.
John.